Hello, this is Dr. Vicky. I was sitting here reviewing your capstone project survey, and I made a few notes here to go over some things with you. Let me pull up the screen so we can talk about it. First off, I'm looking at the financial statements on Yahoo Finance for GlaxoSmithKline. It's a good time to pick a company like that with all of the people trying to find a vaccination for the COVID-19 and all of that. To find a challenge, we're using the financial statements mainly for one reason. It's data that every student has access to. If we use a publicly traded company like GSK, every student has access to this same data for their company. In the real world, as you know, with the engineering firm that you're working for, you have access to all types of different kinds of information and data. So right now, we're just going to use the financial data because that's something you have access to on this company, and it puts you on an even playing field with the other students. So to find a challenge, we've got to find something in the data, in the financial numbers, if you will, that shows GSK has a challenge and ultimately an opportunity that a business intelligence solution might help them overcome. Now, look at financial statements like the income statement, the balance sheet, the cash flow, the stock charts. Look at that information for a company like you would if you go to the doctor and they do blood work, and when you come back in, they have a list of all of these blood results, and it says, this is your number, this is normal, this is high, this is low, and then it'll show where you fall. If it's in red, it's out of the normal. So what we're doing here is the financial results is similar to the blood test results for us. This is going to show the health or lack thereof of every company. So when I'm looking, I've made some notes here so that we can talk about it. When I'm looking at the revenue, let's look at it for a second. The revenue, 19 over 18 is plus 9.5%. 18 over 17 is plus 2.1%. And 17 over 16 is plus 8%. Now, what's that tell us? Tells us the revenue is doing this, doesn't it? Which kind of matches what you see happening on the stock price chart. It's doing this as well. So we had an 8% increase here, a 2% increase here, and a 9% increase here. There wasn't any decreases, so that's a good thing. Now, what we have to look at is what's happening when the revenue comes in. Revenue's coming in the form of sales. That's where it all starts. The money is coming in. What happens to it before we see what's left at the end of the day? What happens to it? What I'm going to look at here is gross profit. Now, gross profit is what your expenses come out of to show you your net profit. So let's see what happened to gross profit. Gross profit, 19 over 18 was up 6.3%. It was up 3.7%, 18 over 17, and 6.6%, 17 over 16. Now, what's that telling me? Yes, it's all increasing, but all things equal, the gross profit should follow the same trend line that revenue shows. If revenue's up 8%, gross profit should also be up at least 8%. If revenue's up 2%, gross profit should also at least be up 2%. So what I'm seeing here is 19 over 18, while revenue was up 9.5%, gross profit was only up 6.3%. So we lost 3.2% just in the cost of revenue. Okay, and what is that? The cost of revenue is how much it costs you to make the items you sold. So for GSK, that would be the pharmaceuticals and the things that they sell, the raw inventory, the work in process, the finished goods, all of those things. That's the cost of making it. So the cost of making the items that GSK sells increased to 19 over 18. How do we know that? Because while revenue increased 9.5%, Gross profit only increased 6.3%. So somehow we lost 3.2% in the cost of revenue and how much it cost us to actually make what we sold. That's not a good thing. Now in 18 over 17, revenue was up 2.1% and gross profit was up 3.7%. So we made up 1.6% more in gross profit 18 over 17 than in revenue. So that was a good year because we at least matched the revenue increase. In 17 over 16, while revenue increased 8.23%, again, gross profit only increased 6.6%. Now, before we go any further, you're probably saying, oh my gosh, that's a lot of stuff. What's that telling me? That's telling me we are not effectively managing as a company our cost of revenue. And what does that mean? Our cost of goods sold. How much we spend to buy the raw materials, manufacture and make and package all of the things that we sell. We're not managing those costs effectively to match the revenue. We're selling the same products almost all of the time, unless something new hits the market, which is not every day. But for some reason, we're spending more money or up and down to make the same products to generate revenue. It shouldn't cost us $2 to make something and we make $1 selling it. We're losing money. So again, gross profit trends should at least be the same as revenue. If revenue's up 5%, gross profit should be at least up for 5%. So that's the first thing. Now, I looked at total equity. Total equity is working out. Its increases are matching the revenue, so that's good. Now, the operating cash flow. Let me find it. Balance sheet. So we have total assets, current assets, inventory, all of these things that we're looking at for bear with me, my computer's acting up. So what are we looking at here? What did I even write? Force. What we have here, assets are increasing as they should. They decreased from 16 to 17, but then they started back up. Current assets are things that you can convert in less than 12 months to cash. Let me say that again. Current assets are things that you can convert in less than 12 months to cash. So that usually includes cash, cash equivalents, okay, and short-term investments. So those are the things that you can use immediately to pay your bills and your salary and all of those things. And here's what I was talking about inventory. What's happening with how much it's costing them to make what they're selling, okay? So this is how much inventory we had on hand at the end of each year. The inventory is increasing steadily, but you may need more in inventory for increased sales. We'll find that out in a minute if that's indeed true. And this is what I was talking about. Raw materials, that's the materials that come in that you have to use to start making it. Work in process, all that means is from raw materials, all this stuff happens, mixing, stirring, all of that. And then there's a finished product. Work in progress is in here, everything that's happening to it before we can sell it, and then finished goods. Okay, now let's look, see what we have here, what all we got. Everything here, working capital. Look at working capital. We have a negative working capital. Keep that in mind for a minute. That means you are going to have to charge expenses because you have a negative in the capital to pay your expenses. So you need to be careful about that. Working capital should not be negative. All right, tangible book value, total liabilities. Okay. Now, what I wanted to show you is In week 4 for the course project, I have this out there. It's called a financial ratio cheat sheet that I made for the students so that they can, what does all that mean? All that gobbledygook I just said, I don't expect you to remember. I have it written down here. What does all that mean? How do we even know if that's good, that's bad? What's it mean? Well, here is your measuring stick. This is how you're going to know whether those results are good or if they're not. Okay, remember what I said about the blood work? They have a normal range to compare yours to. This is your cheat sheet for that. Now we're going to look at liquidity ratios. What does that mean? That means how much cash or cash equivalents, things that we can convert to cash quickly, do we have? Liquidity means, do we have enough of those to pay our current debts? Do we have enough? If we used all of our current liquid cash assets, would it pay all of our current liabilities? Very important, isn't it? If not, you're in the negative, you're ruining your credit rating, you're having to borrow money to pay them, and stockholders aren't happy and the stock starts going down. Okay, so let's take a look. The quick ratio or acid test, it's one of the main liquidity ratios that every industry, every business uses. And what it does is, you can see here, it measures the ability of a company to pay its current liabilities when they come due with only quick assets. Is that important? You bet it is, because as the bills come in, do we have enough ready cash on hand to pay them without borrowing more money and going more into debt? Quick assets are current assets that can be converted to cash within 90 days. Because you get more than 90 days late on something, your credit is shot. So what are we going to do? We're going to calculate and see where we are on this quick ratio. Use cash, cash equivalents, and short-term investments plus receivables divided by current liabilities. Now, what I did was I went back here to, let's look and see of it. What is it? Cash, cash equivalents, and short-term investments. Well, it's all right here on one line. Here they are, okay? So I took 2019. Cash, cash equivalents, and short-term investments was $4,786,000. There was no current receivables in process. What's that mean? They don't let companies charge. They're not owed money from the people they sell to. So we have to divide that $4,786,000 by current liabilities. This is how much money we have to pay within 90 days, what will come due within 90 days. So now we have to go down to current liabilities. We have to divide $4,786,000 by $24,050,000. And when you do that, you get 0.199. 0.199. What's that mean? You can only pay 0.19 of the bills coming due, which you can almost see that, can't you? You have 4,700,000 that has to pay 24 million. That is ugly. The ideal is if it equaled 1. If our current liabilities were 24 million and our cash and cash equivalents to pay them were 24 million, we would have exactly enough money to pay what's coming due. 1 or higher than 1 is a great thing, because that means you at least have enough. You have, not only do you not have 1, you have 0.1. You only have like 19% of 1. You can only pay 19% of the bills coming due. So what is a challenge? One of the challenges for GlaxoSmithKline is their quick ratio, their liquidity. They are not liquid. They do not have enough cash and cash equivalents to meet their short-term obligations and liabilities. Is that a problem? You bet it's a problem. They'll have to borrow money to pay their bills. And because they don't have much assets on hand in cash, their interest rate's going to be higher. So you can see how that's going to go on and on and on. And then I calculated the current ratio. It's another liquidity ratio. The current ratio is basically the same thing. It's a liquidity and efficiency ratio measuring a firm's ability to pay off its short term with its current access, period. within the next year. So we divide current assets by current liabilities. Current assets, 19,491. Current liabilities, 24.050. Can we pay our current liabilities of 24 million with our current assets of 19 million? No, we can't. Before we even do the calculation, you can see that. And when I divide that out, it comes out to 0.81. You can only pay 81% of your current liabilities with your current assets. Again, they are not liquid. Liquidity is a huge problem. They do not have enough current quick assets on hand to pay everything that's coming due. That is huge. Between you and me, I don't know how that could be. When you pay $500 in the hospital for a Tylenol, how can companies not have more money than it? So this is a challenge. This is a challenge that you could address using business intelligence to provide decision makers real-time information in the form of a dashboard, day to day, so they can control what's causing this to happen, okay? Now, debt to equity is also something that if you go to buy a house, your debt to income or debt to equity can't be any more than a certain percentage, usually 38%. So we have that for a company as well. Debt to equity ratio, total liabilities divided by total equity. And that was total liabilities was 61,335. And total equity was 11,405,000. Okay, now what's that mean? The number comes out to 5.37. What does that even mean? Okay, that means our liabilities are 5.37 times our equity. Our liabilities are 5 times our equity. Is that a problem? Yes. A lower debt to equity ratio usually implies a more financially stable business. Companies with a higher debt to equity ratio are considered more risky to creditors and investors. So you should have enough equity in the company to pay your liabilities, right? Because if you don't, we already know we don't have enough cash, right? Can we sell things that we own, our equity, and pay it? No, we can't, because our liabilities are even 5 times our equity. So we have a liquidity problem. We have a problem with GSK and for them to generate enough cash without borrowing it to pay what's coming due. That is a problem. So somehow they're not matching the cash they bring in from sales to expenses, to inventory, to all of those things to make sure that everything is flowing in the same trend line as the money coming in, because it all starts with the money coming in. If revenue's up 5%, expenses should not be up any more than 5%. Gross profit should be up at least 5%, right? The liabilities should not increase any more than 5%, because if so, everything stays the same. And if the net income, it should be up at least 5%. So where's your challenge? We're bringing it in and it's not making it to the bottom line. Your challenge for this company is matching all of these things in here to the trend in revenue in real time on a day-to-day basis, using the data of the company to the specific decision makers controlling these aspects, so that we can match these trends with the revenue, and therefore the profit comes to the bottom line. All right, now how do I know? I remember before I said inventory, we'd get back to that. Inventory is a problem in this particular company. We're looking at days to sales ratios. Days to sales ratio. What that means is how many days of sales do we already have in inventory without making another thing? How many days of our current sales trend do we have already made in an inventory if we didn't have to make another thing? Now, the ideal, which is never going to happen, is you make it as you need it and you have 1 day sales in inventory and then it's been made again for another day's sales. That's the perfect world. That's never going to happen. That's the perfect world. But we should not make less than we're going to sell. And we should not make an excessive amount beyond what we're going to sell, because then you just have inventory setting. Why is that a problem? You've bought all of the raw materials, you've bought all of that, you've paid all the labor to make all of this inventory that's going to sit there and not bring in any cash for an exorbitant amount of time. In addition, when you're talking about days sales inventory for a pharmaceutical company, you know, when you look at your medication, it has an expiration date on Tylenol, on your prescriptions, on anything. Now, if it says it has an expiration date of 180 days, part of what's sitting in the inventory is probably going to expire before they ever sell it, right? So that's a problem specifically in perishable items like dairy, eggs, meat, those types of things, and then a pharmaceutical that has short shelf life. So let's see how many days of sales and inventory do we have. Ending inventory was 5,797,000. Cost of goods sold was 12,141,000. And you divide those out, and that came out to 0.477 times 365. 174 days of sales already in inventory. You have enough already made in your inventory if you didn't make another thing to cover 174 days of sales. Oh my gosh, that's ridiculous. You have got so much money tied up in the inventory that you've already made, and you're probably still making inventory. You're probably still making it. You've got all that money tied up. Now we see why there's not enough current assets, cash, to pay our current liabilities. You're increasing your liabilities by making all this inventory and all the raw materials that you have to buy, and you're decreasing your cash by buying them. So it becomes just a snowball effect. This inventory mismanagement is the number one problem I'm seeing just looking at financial statements with GSK. Over everything we've just analyzed, just about every issue I pointed out that could be a problem can be tied to the inventory mismanagement. So this could be your challenge, managing the inventory to better accommodate the sales, to keep within a certain range. Now, what's it say here a range is? Let's look and see. How many days will it take the company to sell all of its inventory? This is important. So you got to have, they want to know how valuable a company's inventory is. Shorter days inventory means the company converts its inventory sooner. In other words, get cash. The days in sales are a key component. See, this is all your research to say why it's important. Right here, universal for every industry out there. Management strives to only buy enough inventories to sell within the next 90 days. You should not have in any case more than 90 days of inventory on hand, and they have priced that. It should even be less than that when it's a perishable product that they're selling with an expiration date. For one thing, it could expire before you sell it. For another thing, the drugstores and hospitals that they're selling to doesn't want to buy a product that's going to go out of date within the next couple weeks. So it's got to even be a shorter lifespan. So what is a potential challenge for GSK from where I sat? A potential challenge for GSK is managing their days of sales in inventory. With the current 174 days of sales in inventory, they're tying up the cash, which is resulting in a 0.81 current ratio, a 5.37 debt to equity, and a 0.199 quick ratio. They're in danger of being insolvent. They're in danger of having to file bankruptcy. They do not have enough cash to pay their bills. So what's the BI solution? Using Microsoft Power BI, whatever you want to find. If you want to do research and find out what is a good business intelligence platform for a pharmaceutical for managing inventory, you can look for that. But the solution is using blah, 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 whatever the software platform is, to provide real-time, day-to-day information to the frontline inventory managers to do what? To monitor sales increases and decrease day to day to match inventory levels with sales, so they know how much raw materials to make, how much goods in process they have, and how many finished goods they have. So that is how that works. Was my process in finding a challenge. I hope this is helpful. If you have any questions, let me know. Can't wait to see what you come up with.